Hello, everybody. I hope you're staying healthy and safe. As the other Tom mentioned, I'm Tom Bailey, a principal at CBM and the leader of our construction and real estate group. I'm going to be presenting today with Tom Hudson. I'll refer to him as Young Tom, who is a tax supervisor at CBM. Our goal today is to present the loan forgiveness aspect of the Paycheck Protection Program, better known as the PPP loan. As many of you know, even from yesterday's news, the rules for the PPP loan are constantly changing. Yesterday, the House put together some proposals, and we'll get into those details later. But this just serves to let you know you've got to be paying attention to our CBM website and attending our webinars next week, and we'll keep you up to date as these rules are constantly changing. Many issues need further definition, clarification, and we are presenting today as best we know this information as of today. A law could or a proposal could be put forth and turned into law next week, but we don't have that kind of crystal ball. We received many questions today, as it led up to this. We will try to incorporate those questions into our presentation. Some of you can access the bottom left-hand corner of the Skype to submit our additional questions. We'll try to get to that at the end of the presentation. If we don't get to it within that hour allotment, Tom and I, our emails are at the end of the presentation. Feel free to reach out to us and we can answer your questions. A lot of this with the forgiveness aspect is very detailed and very unique to each of you. So we're going to try to give an overall presentation today, and if you have a particular situation, we'll be happy to address that after today's presentation. For those of you who might be tuning in to know about the application to get the PPP loan, we're not going to focus on that today. The forgiveness aspect is so complicated. We're going to focus on the forgiveness, not the application. But again, we can help you out with that afterwards if you're still applying. Just so you know, at the end of the presentation, we have slides on our future groups that are presenting professional services, not-for-profit, auto dealers, small business, and our financial planning group. We'll also be giving future presentations within the next week or so. So please sign up for those to get additional information, and they have the benefit within a week or so of being more on top of these changes as the one that was just done late yesterday afternoon. So if you've received your proceeds, what's next? How long do I get to spend these funds? Where should I spend them? And how does that all work, incorporate into the forgiveness process? We'd like to give that overall view of the loan forgiveness, incorporate some examples, and maybe get into some more detailed definitions. The general overview is the CARES Act was passed in March of 2020, and from this sprung the Paycheck Protection Program, and where they had given out the general information that began the process for people to apply for the loan. At the moment, you have 8 weeks from the date you receive your funds to spend them on certain aspects, certain expenses. If you meet those requirements, you get 100% loan forgiveness. If it's only you meet part of those loans, a portion of it can be forgiven. It's not all or nothing. So we're going to get into how you calculate that loan forgiveness. Some of the important points, probably 99% of you out there today have received a loan that's under $2 million. I think as a general comment, I think most folks are getting anywhere from $50,000 to say $100,000. Those folks, if you're under $2 million, it's been deemed that you've gotten your loan in good faith. Those that are getting loans over $2 million, the likelihood of you getting a phone call from the SBA, they want to talk to you in more detail, is going to be likely. So just be leery of that. One thing I do want to point out to you on this loan forgiveness is if the government forgives 100% of your loan, that is not income to you, that loan forgiveness. And in turn, the IRS says under Code Section 265 that you cannot take those expenses on your income tax return. So be very careful of that. Essentially, if the loan's forgiven, the government's money paid that payroll, not you, and that's how the IRS looks at it. Could Congress come down and allow you to double dip and have your cake and eat it too? We don't know, unlikely, but we just want to make you aware of that for your tax planning aspects at year end when it comes down to deducting these payroll expenses, utilities, and the like. So the overall loan forgiveness application was released in the middle of May, just a few weeks ago. It has some critical clarifications, and there's documents that will have to be submitted at the end of your 8-week loan as it exists today. There's detailed instructions that are also going to be included. I know our website has a lot of information provided in there where we help you calculate that loan forgiveness, and that's a big help. Now, what's in that calculation form? You have a Schedule A. That's a summary of calculations from the PPP. And then from the Schedule A, we have a more detailed worksheet to determine the reductions during that covered period, which, again, at the moment is 8 weeks. A quick refresher on what are the eligible expenses. You have payroll, and that's capped at $100,000. We have an 8-week period to repay, so the maximum you can pay an employee under payroll costs is $15,385. As long as that one individual is paid less than that, it's 100% forgiven. So you have gross salaries, wages, tips, commissions. You have, if you've paid for an allowance for dismissal or separation, that's included. Vacation, the employer paid health care benefits, employer paid retirement benefits, and the state unemployment taxes are included in those payroll costs. Typically, that's now, payroll has to be 75%. They could tweak that. We don't know. The non-payroll costs, these have to be in existence as of February 15th, and those are mortgage interest, your rent, which has to be under a lease agreement that existed at February 15th, and still an ever-changing definition are utilities, gas, water, electricity, internet. Stay tuned for what could be under that umbrella. That's kind of a gray area as we speak. Again, some more key definitions. You have average full-time equivalents. Basically, if you are, this is used to see if your payroll has gone down, you have fewer employees. If you are have the same number of employees as of February, they're making the same amount of salary, hourly wage. You don't have to be too concerned about these definitions, full-time equivalents of the employees, but if you've reduced your staff or paid them less, this is where you have to, pay close attention to some of these definitions. You have a covered period, which is 8 weeks starting from the date the PPP loan proceeds hit your bank. That's when that clock starts ticking, or you can calculate under the alternative payroll covered period, which begins on the first pay period after the first loan disbursement is received. So look at both calculations, see which works best for you. It's not one or the other in most cases, so be leery of that.
And Tom, one important part about this particular slide is when we're going into selecting a period, the reality is each period could have certain benefits depending on when you receive your loan and when your payroll cycle falls. That alternative payroll that they've introduced, that allows you to shift your covered period to a schedule that aligns with your payroll cycles. And some people have speculated that that's a way to maybe get more payroll expenses into that same covered period window of 8 weeks. So you really have to look at the dates, evaluate which period works best for you and your organization or your business, and need to look closely to see where the pay dates fall, your loan disbursement date falls, and the 8-week window falls, so that you can maximize the number of expenses you can fit inside of that window. So that's where you actually put the pedal to the metal there and decide which period is best for you.
Yeah, that's definitely true. One size does not fit all. This whole PPP loan is very unique to each business. And again, one size does not fit all. So work out both and see what's best for you. How does this loan forgiveness work? At a very high level, you want to spend your loan proceeds only on those eligible expenses that we just talked about, your payroll, your utilities, rent, mortgage interest, and the like. You get into spending the proceeds on eligible expenses that are incurred or paid or within that 8-week period under the covered period or the alternative period. And when it comes to payroll at the moment, you want to spend at least 75% of those proceeds on your payroll.
Another thing here too, Tom, on note 2, everyone's talking about incurred or paid. This is something that we spent a lot of time on in the past in a lot of our other presentations, and we were speculating whether or not that's cash basis, accrual basis. The guidance that came out in the most recent interim final rule from the SBA that kind of explains how to do this kind of gives you the best of both worlds for that incurred or paid window. How they instructed it is they use specific language that says you can include in your covered period payroll costs that were paid and payroll costs that were incurred in this covered period or APCP, the alternative period, if you choose to select that one. So what that means is if you have payroll that went through the month of April and you received your loan on the first day of May, you're not cutting the checks for that payroll in that prior month until May 3rd, which falls inside your covered period. SBA is saying that that full amount is included based on the language that says this payroll was paid inside the covered period. But alternatively, when you're looking at the other end of the payroll, the covered period, you're going to have to kind of accrue how many days of a payroll period are in your covered window, even though the pay date may be outside of the window. So if half of your payroll makes it into the last 8 weeks and the other half falls out, then you can include the half in your forgiveness application that was within the covered period, even if the check wasn't exactly cut until a time that's outside your 8-week window. So think of it as both cash and accrual. You have to really pay attention to the dates and how everything falls here. And again, it's all unique for everybody based on their specific dates and payroll cycles, etc. But I wanted to make that very clear that it is incurred or paid. And so they've made this definition a bit broader, and it helps everybody out a little bit more than what we previously anticipated.
Yep, I totally agree. Next slide. So we have potential reductions for forgiveness. Again, with the salary and waged employees, if at least 75% of that salary is provided, the proceeds are spent 75% on payroll, you're good, you've met the safe harbor. If the reduction doesn't apply, you may be limited based on the restored levels during the covered period or the alternative covered period. And we're going to get into the full-time equivalent for the employees, go over the exceptions and the safe harbor. So be careful of those as young Tom takes over and gets into more detail from here on out.
Yeah, so this is just high level what the reductions are. We're going to get into those. But for now, let's kind of step into the application. And this application, it's quite hectic. But in order to give yourself a little bit of a head start, there's a few things that are going to be necessary that you could kind of get together and prepare at least before you dive into the application. As you guys know, I'm sure a lot of you have been running into particular situations that are unique, don't exactly make this easy. I don't think we'll be able to cover all those during just the short hour that we have today, so we're kind of keeping this high-level baseline just so that we can get the concepts across, and of course we're always willing to help everybody out with the unique circumstances that might be troubling, working through the application. So just looking at things that we're going to need right now. You're going to need all the identification numbers that were assigned to you by the SBA. That's your specific PPP loan number and your lender's PPP loan number. They all have identification numbers. Those are something you're going to have to put on the application, so just get them together. Obviously, you're going to need the date your loan was dispersed to you. We've stressed how important that is before. You have to track how many employees you had at the time of the loan application, so the date you submitted your application, and then also the number of employees you had at the time of the forgiveness calculation. those specific spots in time, you have to have employee counts. So you also need to, working through the application, look at if you received an EIDL advance, and if you did receive one, you need to put that into this specific line allocated for the EIDL. And notice that it's just the advance portion. They're not chasing a whole entire loan amount, so do recognize that that's just what they're asking for, which was $1,000 per employee. It could up to $10,000. So if you apply for both of those benefits, you need to be considerate of that because it is reduced out of your PPP loan forgiveness amount. Moving forward, we're going to have to give them a payroll schedule, and essentially what they're asking for in the application is for you to say how you pay your employees and the frequency that you do so. Those check boxes you can check for 2 weeks, every other week, bi-monthly, monthly, and it just gives the SBA an idea of how you're paying your employees, and it's going to help them understand exactly where all your payroll costs will fall. So that's important information that they're asking for. And then they're going to be asking you for your covered period. This is one of the most important pieces of information because that's the 8-week window, generally beginning the date after you receive the loan disbursement. And as we discussed on a previous slide, that includes all the costs paid or incurred within that 8-week window that are generally eligible for the forgiveness. So there's some wiggle room there, though. For example, as I covered before, if you didn't pay your employees for April wages but you paid them in May, there's currently nothing that says that you can't include the payment of the April wages that fall within the covered period of May. So a lot of thought should go into where you choose your covered period. You can maybe run through the application twice using each different period if you want to shift to the alternative, just to see which one can work out best in your favor. I think there's some wiggle room there for sure. So let's start with the application. As I said, it's pretty hectic. You're going to open the app from the SBA and you're going to realize that the whole thing is about 11 pages in total, which is kind of already frustrating, or just piling onto an already frustrating circumstance. But when you read through the directions in the process, you'll find that the application really wants you to start at the third page from the end, which is what they call the Schedule A worksheet. And I have a picture of it here on the slide. This is Table 1. This page hosts Table 1 and Table 2, which is where you're going to list all of your employees. As an aside, this is something we wanted to just bring up for all of you trying to work through this. I know a lot of the third-party payroll providers are generating reports that kind of lay this information out for you. So if you do have one of those major payroll providers serving you, then you're definitely going to want to at least check with them to say, hey, what kind of PPP loan application reports do you guys have available? Because they kind of take a lot of the work out of this, and it isn't too complicated, so I do feel like they're definitely on top of it and could be able to figure it out. So that would be something to think about. But if you don't have that available to you, we're still going to walk through how to fill out these tables and what you're going to need to do. But starting with Table 1, what you're going to have to do is this is for all employees who received cash compensation at an annualized rate of less than or equal to $100,000 for the pay periods in 2019. So that's focused on last year and the annualized salary. If they're under 100 grand, they go in Table 1. If an employee didn't exist in 2019 and they were included in your loan calculation, then they also need to go into this Table 1. But the general rule is that anybody's compensation in this chart shouldn't exactly go above the max $15,384 because that's the max compensation anybody could receive. So begin with Table 1. Remember that cash compensation is salaries, wages, commissions, or other comp. Health insurance and other benefits, they aren't included in this specific table, but how you fill this out is you're going to have their name, you're going to fill it down on the left side, you're going to put their social security number in the next column, and then all of their cash compensation there in column 3. Moving on, you'll see on Table 1, the next column, it says Average FTE. Okay, what in the world is that? What we need to do is calculate how many average full-time equivalencies you had during the covered period or the alternative covered period. How do you do that? Well, for each employee, you need to figure out the average number of hours that the employee worked per week and divide it by 40. So for employees who didn't work 40 hours, you must round to the nearest 10 per the instructions. And they say that the maximum value any employee can have is 1. So if an employee worked an average of 40 hours per week during the covered period, divide that by 40, you get 1. That specific employee, their average FTE is 1. If they worked 30 hours a week You divide 30 by 40, you get 0.75. They tell you to round to the nearest tenth. That's 0.8. That employee represents a value of 0.8 FTE for the purposes of this chart. Relatively simple. But they also make this a little easier for you. They have an alternative calculation, and while there's tons of employers out there who may have people who work different schedules and a lot of people work part-time, it may make the calculation a little bit more complicated depending on how your staff is structured. The alternative calculation allows you to assign a value of 1 for each employee who worked 40 hours, and then a 0.5 for each employee who didn't work 40 hours. So this one doesn't involve any math or rounding to the nearest tenth. Every employee is going to have a value of either 1 or 0.5. Obviously, you're going to want to look at both of these methods to see which one of them gets you the higher number FTE, because that's going to be used in factoring in any type of reduction later in the application. Just know that there's two methods. It involves finding the average number of hours that they worked and dividing it by 40, and that's how you start to assign your values. Again, I think the payroll companies are on top of this. They may have all of this ready based on the time that you submit, for payroll and hours and salaried employees. So should be relatively easy to get this information, and even if you don't have them available, the math is quite simple, but just be aware of how it works. I do have an example just so we can walk through it real quick. It's all relatively straightforward, but let's just say for the purposes of this example, you have an 8-week period and it began on April 20th. You had the following employees. We only had 5. We had A, who worked 45 hours a week. We had B, who worked 40 hours a week. C, who averaged 28 hours a week. And D and E, who both averaged 20. Now on the left side, you can see that doing the math, you arrive at 3.7 FTEs using the first method, and that's when you can round to partial numbers, either something in between, like C. You can see there for employee C, they work 28 hours out of 40. You divide, that's 0.7, so their value is 0.7. If you use the alternative method and you only assign them 1s or 0.5s, you'll see that employee C is the main one that changes in this scenario, and they get reduced down to a 0.5, because if you didn't work 40 hours, you're a 0.5. If you worked 40, you're a 1. So that yields a total value of 3.5 FTEs. In this situation, you'd want to use the first method because it yields a higher number of FTEs for the purpose of the calculation, and that comes in later when you start talking about forgiveness. So now that we see how that works, let's just keep on moving. Relatively straightforward. So everyone, this is where it starts to get a little sticky. But everyone's always been asking, well, I had employees who didn't come back to work or quit or were fired for cause. The program, it really tries to account for a lot of these problems, and I know it won't catch everything, but they're here to offer FTE reduction exceptions. And this is also in Table 1. You'll see it at the bottom when you look through the application. There's a row at the bottom. It allows you to put in a value for the employees who meet these reduction exceptions. That includes people who turn down your offer to return to work. They were employees fired for cause, and they were employees who perhaps just left to seek out another role, change jobs. If you had employees who did not work in the covered period for these reasons and were included in the calculations for your loan amount, you're entitled to put a 1 in this exception column, which kind of negates any type of penalty on your company that could potentially reduce your loan forgiveness amount due to these types of exceptions. So just know that they're there. It gets a little complicated when you start applying reality, because I know there's a lot of unique situations. One of my colleagues and I, we were speculating, well, what if someone quit during the covered period and they worked partially? Do you include them in Table 1 and also an exception, or what? There's not a lot of guidance there, so while they tried to address a lot of specific situations, I do feel like there's still a few occasions that could arise where it's unclear how exactly we need to fill out the application. But that's something I imagine SBA hopefully has more guidance on. We're going to have to see what Congress does regarding changing this. And I'm sure the banks are also clamoring for answers as well, because they're the ones who are responsible for working through these applications. So now we're almost through Table 1. This is the very first table on the very first page. And here's where things get also a little more crazy. So I'm going to try to stay high level here because I know that this can get complicated. But The last column on Table 1 covers a salary/hourly wage reduction. Everyone's heard, well, you could have a loan forgiveness reduction if you don't pay people their same salary as measured in periods previous to the pandemic. So in general, if you've decreased the pay of your employees during the covered period in an amount greater than 25% of their pay, you're going to be subject to a reduction. Put simply, if you decrease someone's pay more than 25%, you're going to run into a reduction. There's a lot of exceptions, but that's high-level general understanding. So how do we do this? What period are we going to use to calculate their base pay? So that's going to be their cash compensation for the period of January 1, 2020 through March 31, 2020. You're going to have to look at how much their annualized salary was through that period. So you take everything they earned through January 1, March 31, and you annualize it to arrive at an annual salary amount. All right, so we do have an example, but I want to still at least walk through this here. 1 second, please. All right, so first, we need to figure out the annualized average salary for each employee during the covered period. That's easy to do. Figure out during that 8-week period what was everyone's average annualized salary. Each employee down to the employee level. Again, payroll reports are going to come in very handy here if you have a major payroll provider. If not, it's just some simple algebra, essentially, that we can help you work through if necessary. But you're going to want to look at how much they made during the covered period, the 8 weeks. And then you're going to want to look at that baseline period that I mentioned before, January 1 through March 31, and you're going to want to figure out how much they earned during that period. You divide their actual salary paid during the covered period by their baseline salary. And if that is greater than 75%, then you haven't reduced their salary below the acceptable level, and you're not subject to any type of reduction. Well, if you did, then you are subject to a reduction, and you have to keep going with this math. So how that works is you have a tentative reduction by multiplying that amount determined in step 2 by 75% and then subtracting the results from step 1. I understand that I'm speaking in mathematical terms right now and it's hard to follow, but hold on, I have an example that we're going to get to. Let me make sure I have my spot. And then, if you start running into reduction issues and you find that you're at the 75% line in the sand, then it gets different depending on salary employees versus wage employees. For everyone in between those who has a complicated compensation structure, I don't think it's been addressed exactly how we're going to handle that. All they address are salary and wage employees. So that's what we're working with at this moment. But you're going to take, for the salaried employee, you take the step 5 result and multiply it by 8 and then divide it by 52 to arrive at the required deduction. Again, I know I'm speaking math, but this is what it is and this is what's laid out for us. Again, the payroll reports could have this filled out for you. I'm not going to rely on them entirely, but it may be there. So for a wage employee, it gets a little bit different. You have to measure the average amount of hours worked per week from the baseline period. You multiply that value by the amount determined in step 1 and step 2, and then you multiply it by 8. This is exactly what the instructions tell you to do, and they walk it through their steps to help you along with that math. And this is what it is. But now let's hop into my example at least. To lay this out very simply, we've got John. John's annual salary was $52,000 for the 8-week period. So what he earned in that 8-week period, when you annualize it for the entire year, you get $52,000. Okay, that's what he earned during this pandemic and during the period, which includes the covered period. John, his annual salary before all of this happened was $80,000, and that was measured by that baseline period that they provide, January 1, 2020 through March 31, 2020. So you divide step 1 by step 2. So it's $52,000 divided by $80,000. That's 65%. That's a reduction greater than the 75%. So now you're going to have to figure out, well, how much am I going to have my loan forgiven reduced by because I didn't pay John enough during the period? And I'm sorry, but it's math. Look at step 5. What we're going to do is we're going to take his baseline salary, you multiply it by 75%, and you arrive at $60,000. $60,000 is what we should have paid John throughout this whole pandemic and the covered period to avoid any type of reduction due to his salary being decreased. We paid him $52,000, so you need to find a difference between those numbers, which is an $8,000 shortfall, the 60 minus the 52. Now, because he's a salaried employee, you have to divide that difference by 52, multiply it by 8, and that means for John, his specific reduction is $1,230. I understand it's hard to follow this just verbally. I highly recommend setting up some Excel sheets to work through this math if you have to, but that is the high level how to arrive at a reduction for a reduction in someone's salary during the covered period. Okay, now this is one of the best parts here. Now that I just explained all of that, what if I told you that everything we just went through and all of that math to determine what the salary/hourly wage reduction was, it could be entirely set aside and ignored if we meet other criteria. So since you put in all the effort to doing that math, let's see if it doesn't even matter. If you're running into salary reductions, you could potentially avoid incurring them and suffering a reduction to your forgiveness. So to do that, you need to look into these steps, and you'll need to follow these steps. But I think this part is easier to walk through with an example, so I'm just going to handle it with a hypothetical. I have the steps on the screen, but listen to me. Assume that on February 15th, 2020, John was paid an annual salary of $75,000. Okay? We look at this specific time that the SBA said, what was he paid on February 15th? You want to look at the payroll period that includes February 15th. Now, after the arrival of COVID-19, John's average salary for the period February 15th, 2020 through April 26th, 2020, it was reduced to $55,000. Okay, that's a $20,000 reduction. That resulted in John being paid only $8,000 in the covered period. I know it's tough, but stick with me. But here's the important point. By June 30th, 2020, John's annual salary was increased back to his original $75,000. So even though we didn't pay him enough during the covered period and we were subject to a reduction based on the math that we previously covered, because we got his salary back to his regular amount by June 30th, the safe harbor is met and there is no reduction for this specific employee. Okay? So I want that to be very clear. Right now, June 30th is the date that they say, if you get their salaries back to where they were before, just write this right now as soon as you can. And this doesn't matter where your covered period is. They say June 30th. This is a specific date. If you get his salary back to the levels it was before, you don't have to reduce this particular portion of the loan forgiveness. Okay? Very important part. Moving on. All right, so after all of that and essentially the bulk of our presentation, we've completed the very first table on the very first page of the application, but we've done most of the work. I know it doesn't feel like we're anywhere near completed, but that is the bulk of the application, and it's figuring out all of these amounts at the individual employee level. But since Table 1 is now complete, you're going to have to complete Table 2. That's the second table on this Worksheet to Schedule A page. It's super easy for this particular part because you only have to now include the cash compensation for your employees, list out their names, their social, and their cash comp, who were capped at the $100,000 limit per employee. Those reductions that we just walked through for FTEs and for salary reductions don't apply to these specific $100,000 employees, okay? So Table 2 is very simple. Nobody should be above the 15,825 amount, if I'm remembering that correctly, on any of these tables. So Table 2, relatively simple. Now, we've done most of the math. The rest of the form is kind of a churn and burn, for lack of a better term. And we can start filling out the application now. So when you move to the actual PPP Schedule A form, so remember there's 3 pages. There's the actual application, and that's the main one. There's the worksheet to Schedule A, which is what we just finished with the tables, Table 1 and Table 2. And that takes most of the work. And then now there's Schedule A, which is the supplementary schedule to the actual application. That's where we are now. It's relatively easy because it just says, hey, take the numbers from Table 1 and Table 2 and fill it in on this application. And they really do walk it through quite simply. You can see line 1, hey, enter your cash compensation from Table 1. Okay, that's something that we calculated and added before. All you do is move that number and put it here and basically fill in the information that you derived from all the tables. If you keep going, we work through line 1, 2, and 3, and it's really just moving number here to there. You're going to just continue on, keep going, and we're going to start getting into cash compensation from Table 2, and then also your average FTE for Table 2, because remember, you need to do average FTEs for Table 1 and 2. That's the math we did before, that we focused on before with the employees, assigning them a value of 1.5. That also gets moved on to this specific application. You're really just flying right through at this point. You did all the hard work, as I said. Moving on, you start to get into, this is slide 27 here. You're going to start moving into some of the expenses that we've heard so much about. This is the employee health insurance, the employee retirement plans, and then, of course, any amount paid by the borrower, the state and local tax portion. I want to be clear that these amounts are addition into the annualized compensation cap of $100,000. So these are those extra benefits that aren't included in cash compensation. So an employee could theoretically have $15,384 of compensation from Table 1 or 2. That would be maxed out. And then they're included on Schedule A, as well as amounts that are allocable to the employee receiving that reflect his or her share of the health costs, the retirement costs, and the state and local taxes. So I just want to make that clear that this is separated from the cash compensation, and this is where that information goes. So moving through the application, this one is one of the ones that really, started to give a lot of us sleepless nights, because we read this in the IFR, the most recent regulations that were released from SBA, and then the application instructions, and we're like, whoa, wait, what is this? They kind of threw a curveball at us. This line is going to create some confusion. Owner, employees / self-employed, individual, general partners, it's a relatively new feature of the program and has been loosely interpreted to include C Corp shareholders and S Corp shareholders as well. Apparently, these individuals aren't supposed to be included in Table 1 or 2 of the Worksheet A, because the health care and the premiums that you'd pay for these specific owners and the retirement costs attributable to the owners and general partners, those expenses aren't forgivable. But if you read the instructions of Schedule A, they don't exactly make that the most clear. So that's something you're going to have to think about. And it's kind of a pending item that we have on the application. I know it's complicated. I'm just trying to bring attention to it. And also, this line kind of adds something new to the equation. It states the following, and that its compensation is capped at $15,384, or, a big or here, the 8-week equivalent of their applicable compensation for 2019, whichever is lower of those two numbers. So this essentially prevents an owner from increasing their compensation during the covered period to maximize their forgiveness by limiting the amount included in the forgivable amount, which is the 8 divided by 52 of a self-employed owner's compensation for 2019. That gets complicated. Let me simplify. If you were a relatively new business in 2019, or your business had lower income due to maybe significant depreciation, transaction that these are typical tax techniques that we would employ to minimize income, because they're available, and that's essentially beneficial to a lot of business owners. So it's something that we regularly employ. If for some reason we did that, or you're just a new business, your 2019 income is going to be the limiting factor of this specific equation, because it may be less than the 15,384, and you're limited to the lesser of these two. So this is a new issue. I think there's a lot more to be discovered on this line as it begins to bring more issues to the table, but we're focused on this for future developments, and really everyone should be trying to stay on top of this line. I think there's still a few things that have to be deciphered here, but just know that this could cause problems if maybe you fall into one of the situations I described regarding 2019. All right. As we progress, we're going to keep moving through the application here, and let me just make sure I'm following along on the side. Okay. This is where we're going to figure out whether or not you have a reduction tied to the number of people who you kept employed. We talked about this before. If you lost employees, they dropped off, you're going to have a reduction. We didn't calculate a reduction yet. Earlier we calculated We went through FTEs and how to account for your FTEs and assign a value to all of your employees based on the hours they worked. And then we talked about exceptions, people who maybe no longer work with the company for voluntarily resigning, fired for cause, or they just turned down your offer to come back to work. We accounted for that, but we didn't account for, okay, you just didn't bring back enough of your employees for whatever reason. I understand it's difficult, and that happens. So this is where we're going to figure out what that means. But fortunately, this calculation, it's a bit easier to navigate. So how are we going to do it? First, we need to look at 2 new periods. Okay? They love throwing all these different date ranges at us, and I wish it was easier, but here's 2 more date windows that you need to look at. First, you need to look at February 15, 2019, last year, through June 30th, 2019, or January 1, 2020 through February 29th, 2020. And notice I said or. We're going to look at either one of these 2 windows. You're going to pick the one that's most beneficial for you. You need to calculate how many average FTEs you had during these 2 periods using the same calculation methods that we employed earlier. That's assigning the value of 1 or 0.5. You have to use the same method that you use to calculate your FTEs. But you need to do that for these 2 same exact periods, okay? And if your FTE count during the covered period is less than either of these 2 periods at your election, then you may be subject to a reduction. Remember I said you can pick between these. So you're obviously going to want to choose the value that is lowest here. Correct. You're going to choose the one that has the lowest value because you're going to compare it to how many employees you had covered during the covered period. All right, so how can we avoid a reduction and qualify for the safe harbor? So if you looked at those previous 2 periods that we just discussed and your employees that you employed during the covered period was less than both of those, you move on to this step. You're subject to a reduction right now, and we're looking for a way out. Remember the salary and wage reduction had a June 30th date that you can start to think about and says, well, if you get their salary back at this level, you're fine, we're going to let you slide. Well, they do the same thing here for FTEs. So first what you need to do is you need to look at, let me see here, February 15th, 2020 through April 26th, 2020. And then also the pay period, they say that includes February 15th. These are 2 new windows, just they're used in other places, but these are 2 new windows compared to the previous slide. So you're looking at 2 new periods. If the average FTEs for the first period is less than the FTEs for the second period, both of the ones listed on the screen, then the borrower must compare the average FTEs for the second period to the total of FTEs at June 30th. Okay, so complicated, hard to follow, I understand. But essentially, if the FTEs on June 30th, 2020 are greater than the FTEs that are measured on February 15th, 2020, then the safe harbor is met and no reduction is required. A bit complicated. You're going to have to reread this 1, 2, 3, 4 times. I know I did. I'm probably on 10 times. But this is the logic, and this is what it is at a very high level. So moving on to the next slide and working through the application. Now you're really kind of rolling. We took care of all the reductions. We looked at it and we tried to figure out, are we subject to them? And then also, can we reach safe harbor and remove ourselves from any type of reduction that's imposed upon our loan forgiveness application? But as we go through, it's really just plugging in numbers at this point. If you keep working through, I know I've covered a lot, but we're kind of on that worksheet schedule, or the Schedule A to the application. And you really just go in and now you key in the payroll costs. We did all of this work earlier. We figured out what the payroll costs are. They're saying, hey, put that number here on this line, line 10. And then now you put in all of your non-payroll costs. You move to line 2, 3, and 4. This is really just moving numbers from here to here. We did the work here to here. It's hard to be able to show you this and the application at the same time, but just listen through and we should be okay. We discussed any type of reductions. As you move further down Schedule A, we account for any reductions that we calculated before and add the FTE reduction quotient, which is something we calculate here on this specific page. So really, you're just working through, you make any adjustments, and then you fill through line 8, line 9, line 10, your payroll costs, and then you arrive at your loan forgiveness amount. I know that's really kind of abbreviated right there at the end, but as you work through, it's really not much because we did all of the work up front, and now we're just kind of rolling through and plugging in the numbers, and bam, you arrive at the loan forgiveness amount. And this will be listed on the actual application. It's the very last line, and you can arrive just working through the math, reading the lines, the total loan forgiveness amount. All right, 1 second here. Okay. Now, we did the math. We figured all of it out. Now, what's happening with all of this? We mentioned it briefly before. We love going through these concepts, and we want to share with everybody how this works right now. But the fact of the matter is, I don't know how Congress feels about a lot of the restrictions that are currently imposed on the program. As of yesterday, the House, I'm sure a lot of you have seen, and we'll get to questions here in a moment, everybody, but I want to cover that the House and the Senate is going to vote on this exact bill later sometime next week, but they're changing how this application is going to work. So everyone's going to have to remain, keep their eyes open and watch the developments. Some of the changes, Tom mentioned them earlier in the presentation. It changes that 8-week covered period to 24 weeks. So they're going to drastically expand how much time you guys have to spend this money. I think they've realized, hey, this might be kind of restrictive, and a lot of businesses aren't open yet, and this 8-week window is already ticking because folks were on top of getting these loans back in April. So it's just something we're going to have to pay attention to and see how that develops. Further, they're looking at changing that 75-25. This is very big because that 75-25 allocation is something that we've been harping on through all of our presentations and has been a very critical part of this. And if you think back, the SBA themselves implemented this. They said, we think 75% towards payroll costs is about appropriate, is an appropriate proportion as to how this money should be spent. This was not written into the original CARES Act. SBA kind of flexed their muscles and added this part, and I don't think Congress liked that. So they're trying to change that ratio, make it a little bit more forgiving, and let you spend some of your money less on payroll costs and more so on some of the other items, the mortgage interest, the rent, utilities. Just know that they're looking at this, and it's just developing right before our eyes. So we have the information available as it is today, but constantly changing, and that's what makes this fun. I mean, we have fun. Documentation. On the actual application, you attest to this statement that I have listed on here that says, I submitted to the lender all the required documentation that verifies all of the stuff that I have on this application. They go through and they do say in the instructions to the application, these are the things we want. You know, it's kind of broken out piecemeal, but when you get to payroll and things like that, they want to see the bank account statements where the money's going out to the employees. They want to see any third-party payroll reports. They want to see all the payroll tax forms that you guys have submitted to all of your to the federal government and the state governments covering unemployment and then all the payroll taxes, etc. They want to see all payment receipts, canceled checks, copies of those canceled checks, or account statements that. And this is more towards the rent that you're going to pay, the mortgage interest that you're going to pay, and the utilities. They want to see that money going out. So that's some of the stuff you have to think about having ready, at least as we move into, whatever this eventually changes into. I'd love to address a lot of these questions. Tom, I see you've been handling a bunch of them. I see one popping in just here at the bottom. If they change it to 24 weeks, what will happen if we meet all the loan requirements by the end of the 8 weeks? I'd say you're sitting pretty. I don't know what that does to the timeline. It's hard to speculate on what they're doing because all we have are articles and at least the text to the House bill that kind of, it does give some of the specifics, but you know how Congress works. Senate has to get their influence and they might change something and then they sign and then the House has to agree. So that's how that process works. So I don't want to hang our hats on any of the information that we know right now because it is too soon, even though we're talking about this being changed potentially by next week. But I wouldn't start worrying about it yet until we have final answers that say this is what it is now.
Hey, Tom, can I interject real quick?
Sir.
I just wanted to remind you and Tom Bailey that we do have several people in this meeting that are on their phones. and don't necessarily have access to the chat box. So to the extent that you have time left to articulate some of the questions that have come in on the chat box, I think the people on the phone probably would want to hear what those are.
Sure.
Thank you, Joe. The difficulties of presentations virtually. I do first, though, Joe, I want to talk about some of the questions that were submitted to us, and I will run through those and just read out those questions, and we'll try to get through as many as we can with the last few minutes that we have here. And then this starts to go into, let's read the first question. Somebody was asking about 401k profit sharing, and they specifically mentioned top-heavy contributions for shareholders eligible for forgiveness in excess of the $100,000 cap. I mentioned this before, that new category that they kind of sprung on us that says the owners and the specific shareholders, they're going to start limiting it to 2019, and then also a lot of the benefits that you paid for them aren't included. So this is a sticky one. I'd be careful. I think it has to do with further developments going forward. I can't answer that right here on my feet, at least without looking into it more. Someone asked if business owner draws, are those considered forgivable? So that depends on a lot of things. It depends on what type of entity structure we're talking about. Those specific distributions in all cases don't qualify for any type of forgiveness. But if you were a Schedule C type person, the forgiveness is kind of different, where you don't necessarily have to have payroll costs. So some people have said you should take a draw and move that money out of the business. That's something more of speculation, but draws aren't considered part of the equation anywhere in this application and aren't considered in general. Someone said, and these are more so back to some of our other presentations, that they've heard that the PPP funds could be used for legitimate expenses other than payroll. What are those expenses? The eligible expenses we did cover are the ones that are specifically named in the bill. That includes the payroll costs, of course, the mortgage interest, and then the rent where there's an agreement, and then your utilities. And that's what the funds are supposed to be for. And they're pretty hard line about that, so I'd be careful. Someone asked, hey, what if you hire new people during the 8-week period or fire someone during the 8 weeks? I think we addressed that. They'll be, of course, used in accounted for in that Table 1. If they weren't included in 2019, you still add them to Table 1, which is on the worksheet to Schedule A. We went through that, and that's where a lot of the bulk was done. Include them there if they weren't employed last year. And then if people left during the period, as I said, if they worked somehow within the covered period, you may run into issues because I don't think it's clear exactly how we count for them, but they could qualify for an exception, and you shouldn't be penalized for any of the reasons that they cited previously of people moving in and out of employment with your company. As long as everything's clearly documented, especially that offer for folks to return that was rejected, make sure you've got all the paperwork and documentation for that. Very important. Somebody's asking about self-employed individuals, how they calculate their loan forgiveness. You're going to be working through a lot of the same logic. There's a few small quips that are different for self-employed individuals. I don't think we have time to run through that. We've covered it in other presentations, but if you are self-employed and you think there might be issues regarding your specific loan forgiveness, definitely reach out, because that math is a little different, and it is a little, you don't have payroll costs, right, if you're just a Schedule C and you're your only employee. So it does work a bit different, and there's a formula to determine your forgiveness, and you kind of automatically qualify for it. Again, outside of the scope of this presentation, but we'd love to talk about it. If you've got more questions, please follow up with us. A lot of questions about, everyone's focusing on the utilities, and I see we have a question in there about cell phones. Are they included in utilities? So they did enhance that definition a little bit. They went and added something that said internet access, and there was another one. It's kind of broad. I think you've got to be a little conservative when you start getting into this. As long as you've been paying the bill regularly, some people have been including cell phones. I think that flies, in my opinion. There isn't anything that says no, cell phones don't count. They do say telephone. Whether or not they're going to get into the difference between telephones and cell phones, I don't know. I have a feeling it would qualify, but the way all of this works out, it should be relatively minor in the scope unless you have a very large cell phone bill, which is entirely possible. Someone was asking, can we include the employee owner payroll in the forgiveness calculations? And then they're asking specifically about a sole proprietor. and how that works. That's 2 questions. Again, it's different if you're a sole proprietor. It's kind of outside of the scope of this presentation. We do cover that, and maybe probably more so in our small business presentation that is coming up on June 9th. Thank you, Tom. June 9th, where we have our small business team. I'll be there, and we do get into that issue a little bit more. Maybe tune into that one to get the answers to that question, because we will discuss it more so with a sole proprietor tune. And then we also, their other question, employee owner, we talked about that. It's that scary line 9 on Schedule A, where they kind of threw that on us, and they said, well, you could be subject to the lesser 2 of your 2019 income. So stand by on what this means for employee owners, because it just got a lot more complicated, and we need more guidance to give clear answers on how to account for those owners of the company. It gets a little worse, unfortunately. So we're standing by, hoping for an answer there. I know that's one of the, at least in the community, tax community and the PPP community, that everyone's looking for answers for. And this is a great question to really wrap it up here. Somebody asked, should we anticipate another round of payroll loans and thus prepare payroll records to qualify? I think the fact that Congress is still laser focused on this program means that this isn't exactly the end yet. They're changing it. They're making it longer. There's currently still funds available for folks who are applying for loans. I think this all depends on what happens with the pandemic. And this is Tom, young Tom, for the purposes of this presentation, speculating. But if this continues and we're unable to fully return, I do think potentially there could be another round. But that is my personal opinion and just me guessing. No one knows what the future holds. And we're just going to have to, of course, live by the edge of our seats like we've been doing and work as fast as we can with all the information that gets released. I know it's a lot. We're working really hard to understand all of it as best as we can so we can get that information to you and your organization. So with that note, I do want to reference on the slide, I know everyone can't see it, but we have upcoming presentations all through the beginning of June, the first week or 2 in June, and then we have some in July. And the one in July is more financial planning focused. They've come up with a title. We weren't able to exactly add that to our slides yet, but just know that on our website, which cbmcpa.com, you can go to events and you can see all of the ones that we have planned. We're going to go through this presentation a few more times, so if you want a second round, we'll all be there to explain it again, and hopefully we have more answers, at least as Congress changes things up and makes updates to the program. So stay tuned. We've got more content coming, and a lot of good stuff coming out of CBM that's going to help everybody through all of these trying times. So we've got a link. It's in the slides, or you can find it on our website. All that information is there. And of course, if anyone has any questions, realize that they want help with this, or just really want to talk about it, you can contact Tom Bailey. You can contact Tom Hudson. Or you can get in contact with whomever you work with at the firm, and we'll make sure that we get you answers that you need to get this done right and to help you out. So with that, I think it's time to conclude. Tom Bailey, any comments?
No, I think most of the questions that were addressed through the Skype, those answers could be found within the slides. There might be 1 or 2 that were more complicated, and we'll get back to you individually. That just needed more detail and are outside the scope of the presentation.
Great. All right. Thank you, everybody. And with that, we're going to conclude. Thank you for tuning in, and everybody have a great weekend.
Thanks. Have a great week. Take care.